Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. Corey and Chad here, your hosts for the weekend edition, also your hosts throughout the week on our website, kereport.com, and podcast, The KE Report. It's going to be a busy weekend for us as there are a couple resource conferences in Vancouver that Chad and I are both attending. So posting on Monday will definitely be a bit lighter, but that is because we are taking time to meet with a lot of resource companies, a lot of juniors that are coming into Vancouver. We'll keep you all up to date on the meetings we have, and please keep in touch with us in terms of companies that you think we should be swinging by their booth or setting up extra meetings with. We will for sure do that and follow up with all of you. To kick off this show, happy to report we have Rick Rule back on the show, founder of Rule Investment Media. Now, Rick, we're going to go around the horn here, a number of different commodities we're going to talk about, and I really want to start with the one topic that is first and foremost on a lot of precious metals investors' minds. That is how you are seeing the value or market cap of gold stocks, gold equities, to the underlying gold price. It's been years that we've had many gold commentators say, we haven't seen stocks this cheap compared to where the gold price is. Unfortunately, it seems like this disconnect is growing almost. Rick, how do you view value of gold stocks to where the gold price is?
Well, arithmetically, if you don't believe that the gold and silver price is going to fall, arithmetically, it's arguable that the market capitalizations of gold and silver companies relative to the underlying commodity price is the cheapest that it's been in 50 years. Commentators say that that has to do with the market's anticipation of a decline in inflation and the fact that gold, from their point of view, is no longer necessary. They will suggest that the price of gold equities suggests that the price of gold will decline. My own suspicion is that they're wrong and that gold and silver equities prices are, in fact, cheap. And I would like, if it's permissible, Corey and Chad, to defend that thesis briefly.
By all means, please.
In the first instance, inflation as measured by the CPI, the Consumer Price Index, I think is a misnomer. The CPI is, by anybody's estimation, a constructed index for at least three reasons. The first is that it's hedonistically adjusted, which is to say it doesn't take into account the cost of living, but rather adjusts the so-called cost of living by bureaucrats figuring what the true value of your apartment or home is and what the utility that they can attribute to your computer is, which is to say it doesn't measure the real cost of the goods and service, but rather the imputed value delivered. It's a manufactured index. The second thing is when it's inconvenient, it doesn't measure food or fuel. I guess that's okay for people who don't drive, fly, or eat. But for most people, a CPI that purports to be a cost of living index that doesn't measure food or fuel is irrelevant. But the biggest problem that I see with the CPI as a measure of the deterioration of purchasing power, which is the other way of saying inflation, is that it doesn't include the impact of tax. For almost all of your listeners, gentlemen, tax constitutes their largest cost of living expense, larger than housing, larger than energy, larger than transportation, and larger than food combined. And the idea that the CPI is construed as a cost of living index when it doesn't include the largest cost component, and by the way, the fastest increasing cost component of any of the components, suggests that the CPI is in fact a lie. When I back tested my own expenditures, admittedly crudely, over the last 5 years, what I learned to my chagrin was that the basket of goods and services that I personally consume is increasing at price at about 7% compounded, which is a different way of saying that the present value of my savings and the present value of my income is deteriorating in terms of consistent purchasing power by about 7% compounded. What that means is that if you are planning your future lifestyle and you are using the CPI number at 2.7, you are understating the impact of inflation on your personal budget by in excess of 4% a year. I watched exactly the same circumstance occur early in my career, in the early part of the decade of the 70s. The outlook for inflation was crystal clear to anybody who cared to look. But people were lulled into a sense of security by the beneficent economic climate that we enjoyed in the 50s and 60s. And I would suggest to you, gentlemen, that people's expectation of inflation in the future has been not tempered, but rather stilted by the fact that we've gone through probably 40 years of the most benign economic climate in human history. And I think that when the reality of a deterioration of purchasing power at 7% comes into conflict with the expectation set by a 2.6 or 2.7 CPI number, that the realization of the importance of hedging accounts to inflation will become very, very, very apparent to people. My suspicion is that the circumstance that we have seen in 2023 mirrors the market circumstance that we saw in 1975. In 1975, an increase in nominal interest rates clobbered the gold price and clobbered the gold stocks, despite the fact that we were in a 10-year-long bull market. In 1975, late in 1975, when the Fed lost its nerve and lowered interest rates, then gold and silver stocks were in fact off to the races. I'm not suggesting that in 2024, gold and silver stocks will be off to the races. I am merely suggesting that inflation is likely more persistent and higher than people believe. And as the narrative changes from inflation has been tempered to inflation will be with us for a substantial period of time, particularly if that's accompanied by lower interest rates, I think that you will see gold and silver stocks do very well. One other fact is that the market share of precious metals and precious metals related investments is the lowest that it has been in my lifetime. It is estimated by JP Morgan Chase, no friend of gold and silver, that the market share of precious metals related investments in the US savings and investment market is about 0.5%, which is to say 0.5% of all the savings and investment assets in the United States are denominated in gold and silver. This is down from a 4-decade mean of 2%. If gold and silver were to return to their 4-decade mean, which is what I think will happen, then demand for precious metals related assets, both bullion and stocks, will quadruple. And I think that that will occur within the 5-year time frame. So I personally am attracted to gold and silver stocks. Does that mean that your listeners should cash in all of their investments and go out and buy penny dreadfuls with the money? Of course not. The truth is that these are some of the most volatile asset classes known to humankind. And a fairly small investment in gold and silver in the type of market that we saw in the 1970s will shield a portfolio from all kinds of sin elsewhere. Don't overinvest in a theme, no matter what the theme is. But my suspicion is that gold and silver are out of favor because people are backward looking, not forward looking, but not backward looking enough that they take into account history that happened in the 1970s. Rather, backward looking enough that they only take into account what happened in 2021, 22, and 23.
Yeah, Rick, some great points on inflation, how it's calculated versus the reality most people are facing. And it's an interesting time where we've seen, as you say, one of the most aggressive rate hiking cycles. And now, even if they shift to a more loose monetary policy and start cutting, it seems like inflation may be stickier. To the point about the gold stocks having such low valuations, a lot of people point to the dilution the sector has had over, let's say, the last decade, where gold has channeled sideways from that 1921 top in 2011, hit over 2000 again in 2020, again in 2022, and again last year, and looks to be close to breaking out. But they're saying, look how much dilution the sector has had. then again, there's been a lot of value creation with acquisitions and buying projects, but then there's also the cost factor. The costs have crept up, but we've seen inflation moderate and we've seen the metals prices break out. Will it take a big breakout, let's say a couple $100 in the gold price or a couple bucks in the silver price to really fatten up the margins? Or do you think that the valuations are divorced for something beyond just dilution and cost?
3 points to that. The first is that if you're investing in the gold and silver sector in the bullion, you don't care too much about corporate performance. From my point of view, people who don't own a little bit of gold and silver bullion, if for no other purpose than insurance purposes, are people that really need to examine their investment performance, meaning I think that people need to do it. If you look at the stocks, one of the things that's held them back, I think, is the anticipation of failure. That anticipation was born more, I think, in the decade 2000 to 2010, where the corporate underperformance of precious metals companies at all valuation levels, which is to say penny dreadfuls all the way through the best of the best, could best be described as horrific. The truth is that if you look at that decade, the gold and silver, the gold price advanced from $256 to $1,950, and the free cash flow per share in the XAU declined. It took real skill to mismanage a price move of that magnitude as badly as they did. I will point out to the pessimists, however, that virtually without exception, the management teams that presided over that destruction of value were thanked and excused, allowed to pursue other employment opportunities. And I would suggest to you that the industry is better led now than it was then. It would be impossible to be worse led. But I would suggest to you also that the investors in this space are much less tolerant of corporate shenanigans than there were in the past. That notwithstanding, Corey, we have talked on your show before, going back 20 years to the Corlin days, about the fact that you need to be, particularly in the more speculative part of the market, the part that will be in evidence at the VRIC, that probably 85% of the companies in the sector have no value. They're lifestyle companies. They're not gold or silver companies. So it's important to understand that you can't buy the sector in the juniors. If you do, you will lose money. The truth is, I believe that at least 85% of the companies in the sector are valueless. That disguises the fact that the 15% remnant generate so much performance that they add luster and legitimacy and occasionally even luster to a sector where 85% of the population is totally useless. What that means is that as you go searching for alpha in the sector, which is when you hang out in Vancouver, when you look to the juniors, stock selection is everything. My suggestion to you is that those investors who are looking for beta, which I would describe as the outperformance of a sector relative to the broad market, that you can buy the top 5 or 10 companies in the sector if you have a 5-year holding period with relative impunity. I'm not suggesting necessarily that you can buy the index, but certainly I think that you can buy 5 or 6 very high quality names with fortress balance sheets, and you can buy them with absolute impunity today.
So, Rick, what are some of the higher quality names in terms of characteristics of the stocks then? Because it's such a wide world out there. How do you go about filtering down what are either red flags or what, I guess even more so, stands out to you as a quality issuer?
Well, I think Franco-Nevada is unusually cheap today. The problems around Cobre Panama, which constitute 15% of the net present value of Franco-Nevada, has caused the stock to fall by 40%, which is to say the succession of production at a deposit which accounted for 15% of the net present value of the issuer has caused the issuer price to decline by 40%. This is the highest quality gold company in the world. And by the way, I don't think that the final chapter in the Cobre Panama story has been written. I think that there will be a recovery either via international arbitration or much more likely a political accommodation between First Quantum and the nation of Panama. So I would suggest to you that the highest quality gold company in the world is anomalously underpriced as a consequence of an overreaction to the occurrence of risk. In second place, I probably would put Wheaton Precious. a streaming company where the cost component of what they do is already baked in the cake, where you don't take operational risk, but you merely participate in the upside inherent in very large projects geologically and also in precious metals prices. Moving down the quality trail a little bit, if you are willing to take a bit more operational risk, I think you need to look at a name like Barrick. Barrick will likely sell off if they are successful at taking over First Quantum, because investors would rather see the money that they would spend to develop Reko Diq and Cobre Panama return to shareholders by way of buybacks or dividends. But the truth is that both of these activities, while holding political risk, are extraordinarily accretive to the company in the 5, 6, and 7-year bases. Agnico Eagle, it appears to me, simply goes from strength to strength. And I think that that's certainly a name that would be attractive from a beta viewpoint. And the recent acquisition by Newmont of Newcrest is one that hasn't been treated well by the market. But I think the rationalization of the combined companies, the ability of the company to sell off tier 2 projects, to strengthen the balance sheet and allow management's time and attention to be focused on the biggest and best assets in their portfolio, is one that over the 4 or 5 year time frame will treat shareholders extremely, extremely well. Those are a smattering of names. If you want to take a bit more risk, I think the recent sell-off in Endeavour Mining as a consequence of the termination of that company's CEO for alleged financial improprieties has caused a company which has been a serial outperformer for 10 years to become anomalously cheap. It is true that one, when considering Endeavour, needs to determine how deep the financial rot was and whether the examination into the company's finances will uncover any wrongdoing in concession acquisition in Africa. This is a riskier name, but it's certainly very, very, very cheap. And for people who can afford to take more risk, there are lots of opportunities in the single asset producers or the intermediate producers, where in the event that the gold price even holds steady, either their share prices rise or they are taken over by larger companies with more liquidity and a lower cost of capital. A wonderful set of circumstances. What's really changed for me personally, Corey, and this may or may not resonate with your viewers, is really since 2010, I've been out of the hyper junior market. I've been out of the sub 10 million market cap market because I didn't think that market was demonstrably cheaper on a net asset value basis than the less risky companies. And I felt myself that the terms involved in private placements in the hyper cheap companies were too expensive. They didn't factor in the risk that the investor was taking. Just in the last 4 or 5 weeks, I've seen private placement offerings come around from companies that frankly had to raise money that I felt compensated me for the risk that I was taking in putting that money up. So I'm looking forward at the VRIC and later at my own conference to walking around the exhibit hall and really getting to know the hyper risky, hyper speculative side of the market. Again, that's where I cut my teeth. So I'm going to spend 2024, I think, looking at places that other people don't look at. I'm very much back in a risk-on circumstance. I'm back in a market looking for 10 baggers and 15 baggers, hopefully 10 baggers and 15 baggers with a full warrant, knowing that I will lose more times than I succeed, which is to say, out of 10 starts, I'll probably lose money 6 or 7 times, 20 or 30% of the money that I invest. But hopefully in 1 or 2 of those 10, I'll get a 10 bagger. If you get a 10 bagger with a full warrant, it's important to know that you didn't get a 10 bagger. You got a 15 bagger or something like that. So I'm back in the game, Corey, in terms of looking at the hyper speculative part of the market and thinking more about my upside than about my downside.
Well, Rick, just to the point of looking at the juniors and the hyper speculative side of the market, you've made the point in many interviews and on our show before that your background was as a credit analyst, not as an economist. But you do look at, lending money to companies and the terms, and with the interest rate environment where it is, with the sector sentiment as depressed as it is, and with it really being a story of the haves and the have-nots, there are quality companies, quality management teams that have access to capital that have been able to raise. sometimes pretty dilutive raises, but still they've been able to build value. And there is a huge swath, maybe that's that 85% you were referring to, that have just really struggled to raise any money at all. We've been wondering, is there even going to be any work programs in 2024? Because so many companies don't even have the funds to keep the lights on, much less really fund an aggressive exploration or development project. How are you looking at the setup between, I guess, the haves, the companies that do have big work programs set up this year but have already raised capital, versus the have-nots that have their hand out looking to raise money in a very tough market?
If I'm right, unfortunately, the have-nots will survive. That sounds very harsh. My suspicion is that 2024 and 2025 will be pretty good markets, and they'll be led by those that are deserving. The share price performance of the deserving will probably, unfortunately, lead to hope among uninformed check writers who will keep the lame, the halt, and the blind. The 85% of those companies existing that don't deserve to exist, will probably keep them alive. I say unfortunately, not because I don't feel for the employees of those companies, who I believe deservedly should lose their jobs, but rather because I think if the industry was rational in terms of capital allocation and more money went to deserving people with deserving projects, that the investor in the industry itself would be better served. You may recall, Corey, in an earlier interview that we did, probably 10 years ago, I described the fact that an intern for us once took 25 then VSE companies, that'll tell you how long it was ago, now TSXV companies, at random, and looked at the balance sheet and income statement, and found that for the 25 companies selected at random, more than 60% of the money raised was consumed by general and administrative expense, and only 40% went in the ground. If you start with the postulation that exploration is a risky business to begin with, and then you burden the exploration expenditure by a 60% G&A charge, you can see that the expectation of success in exploration for those companies is functionally zero. So when you describe a circumstance where the have-nots go begging for capital, I think that's extremely healthy. And I hate to say, and this will obviously get me a lot of hate at the VRIC, but I hope that 2024 and 2025 are years that are discriminating enough that we see 1,000 companies go to company heaven. I don't suspect that that will happen, but that would be a realization of my fondest dreams.
Well, if history is any guide for us, we all know that these companies are going to survive somehow. But Rick, one argument that we have heard within the especially gold sector, but resource sector broadly, is that companies aren't innovative enough. They're not marketing the right way. They're not utilizing new tools. They're not developing new tools to either find metals better, produce metals better, what have you. What's your thought on this concept that, yes, the market doesn't care, but it's also on the companies and the sector to be better and do better things?
I think that's a wonderful comment. Let's look at it a few ways. I would suggest that particularly with the TSXV, for 40 years, too much onus has been spent on taking a 25-cent stock to 43.5 cents, which is to say that too many management teams have recycled a project which has failed in the last 4 booms, a project that had one good drill hole in it. And what the management team does in the first instance is that they option the property. And secondly, they twin that one good hole. This isn't exploration. This is stock promotion. This isn't geared at all to achieving exploration success, but rather to lowering their cost of capital and ensuring that their salary is maintained for 18 months to 2 years. And certainly my hope would be that that falls aside. My suspicion too, and this will be unpopular, I think, among your listeners, is that speculators and managers both need to fear political risk less than technical risk. It is true that the politics of emerging and frontier markets is less understood and more tenuous than the politics around the United States and Canada. But it is also true that really, truly world-scale deposits will be more frequently discovered in places with great prospectivity, but less competition. And I think the industry and the investors, too, need to emphasize technical success more than they need to emphasize political risk. I would suggest to you that every single political jurisdiction in the world is risky, that there is no safe jurisdiction in the world. I personally have been treated much better in places like Congo and Chile than I have in California or other states in the United States. And so I think that the market needs to take into account real risk as opposed to other risk. And I also believe that it's incumbent on capital markets and capital markets participants not to keep metaphorically passing the collection plate through the choir, but rather to expand the congregation. In my own business, Rule Investment Media, I've been very active on social media. That was partly an outgrowth of my former work at Sprott, where in 2011, 2012, we noticed that our investor market was mostly comprised of people who look like me, old, bald, fat, white, rich males. And the fact is that demographic was identified as really, truly dying. When, as a consequence really of trying to lower the cost of reaching those consumers, we began to adopt a social media policy. What we found is that the potential market was much broader than the market we were serving, to the extent that now my 80,000 subscribers at Rule Investment Media, at least those subscribers who we've added in the last 3 years, are predominantly under the age of 40 and are 35% female. They are very often non-white. If a 70-year-old person like myself can expand his audience from 5,000 people to 80,000 people and can experience growth in every single demographic area and in every single geography in the world, the mining industry can do it too. It is too common for the lifestyle promoters in Vancouver merely to circulate the collection plate through the choir in good markets and then live off the accumulated capital during the bad markets. And the industry needs to be much more innovative in terms of accessing pools of capital that exist where those capital pools do exist. I myself have been extraordinarily successful at this. And if an old 70-year-old dinosaur like myself can do it, certainly the young, aggressive, smart management teams that inhabit some of the companies in this space can do it too.
Great comments, Rick, on widening the scope of the audience for the sector and getting a more diverse group of people when that collection plate does go around. One other question we want to work in here real quick is about M&A. We've seen over the last year or two, really the big focus has been the big boys acquiring the big boys. Just to your point earlier about some of the quality stocks at the top of the batting order, you know, Newmont acquiring Newcrest, Barrick going after First Quantum, Agnico Eagle acquiring Kirkland Lake. It's really been those kind of mega mergers that have fueled, and we've seen that in the base metals too. There have been a handful of deals of single asset producers being scooped up or development projects being scooped up, but they've been few and far between. Do you anticipate seeing more activity where those single asset producers or development projects finally get grabbed by maybe the mid tiers or maybe some of the other producers in the year to come?
Yes, yes, and yes. Right now, the hyper majors have much more volume and much more trading liquidity, which means they have a lower cost of capital than the intermediate producers. Either the intermediate producers' share prices rise or the senior producers will take them over. Similarly, single asset producers have less trading liquidity than intermediate producers and much less trading liquidity than the hyper majors. Unless their share prices go up, they will certainly be taken over. But it's important that everybody understand that this M&A is extremely healthy for the sector. Larger asset sizes, larger trading trading floats, larger trading volumes raise share prices, which lowers cost of capital. Cost of capital is a determinant of success in a capital-intensive business. Two, an intelligently constructed merger lowers the general and administrative cost relative to assets under management and relative to EBIT, which is to say the companies with size become more efficient. Two, the larger companies are able to sell their second tier assets and focus on their high quality assets, which is a very important thing. Where the M&A cycle should be occurring among the juniors is where it's not occurring. The need for scope and scale, the need for reduced G&A, the need to focus on high quality assets is most acute in the juniors. Unfortunately, among the juniors, the resistance to M&A is the highest. And this is because of management's intransigence. In every acquisition, there's a winning team and a losing team. The losing team may be compensated for losing, but the truth is that they lose both their dream and, to them, more importantly, their salary. So the sector of the market that needs the M&A the most is unfortunately the sector that will see it the least.
Well, Rick, before I get you out of here, I know that you have a special invitation for our listeners. Please share that with us.
If they go to Rural Investment Media, they can list their natural resource stocks, and I will personally rank them. No charge, no obligation. Go to ruralinvestmentmedia.com, list your natural resource stocks. I will personally rank them 1 to 10. I'll comment on issues where I think my comments might have value. Please, no crypto. Please, no pot stocks. Please, no tech stocks. Let an old man do what he does best, which is natural resource stocks. Rural Investment Media, list your natural resource stocks. I will personally rank them.
Rick, thank you so much. That's so valuable. I will post a link to Rural Investment Media. I hope all of you, our listeners, take Rick up on that offer. Always a pleasure chatting with you. And hey, I greatly appreciate your honesty, whether listeners like it or not. You've been around for quite a while in these markets, and you've always told it kind of the way it is. But interesting to hear that you are starting to get a bit more aggressive in almost the micro cap juniors. Sounds like because the terms are just so attractive. Boy, oh boy, we've seen companies really, really desperate to raise money. So, Rick, I'm going to be having you back on this show next month in February. We're also going to be seeing you in Vancouver very soon. Safe travels up to Vancouver. And Rick, again, thank you so much for your time on this weekend show.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. I hope everybody enjoyed those first couple segments with Rick Rule. Focus more on the precious metals. Now we're shifting our focus more to the energy sector, as I am chatting with Dan Steffens, president of the Energy Prospectus Group. As we usually do with Dan, we're going to start off with more macro comments on oil and natural gas, and then get into a couple company questions that all of you have sent in, as well as some companies that Dan thinks are just broadly undervalued due to where the market price is and their production data. Dan, let's start off with the oil price. Not much to talk about in terms of oil other than it's trading in a tighter range. Since really mid-November here, we've seen highs of close to $80 and lows of about $67. It's been honestly kind of a boring trade recently as oil is stuck in the low 70s. Dan, what are some of the catalysts on tap that could break oil out either to the upside or the downside?
The oil actually came in above my forecast for the fourth quarter. It actually averaged, WTI averaged about $77 a barrel for the quarter because, in October, I think we got to 92 for a few days and then it dropped and traded in a low range, got to the low 70s. But I just want to remind everybody, these companies are very profitable if oil stays at 70. I mean, they made it through a long period of oil below 50. And so, and the balance sheets are in really good shape. So the companies themselves are doing fine. The gas price has been a real disappointment at this point, but maybe we're going to get a big, very bullish storage report next week, so that'll be interesting. It's really, as we were discussing before we got online here, I'm amazed with this stuff going on in the Middle East and with the Red Sea and all the ships having to not go through the Suez Canal, that's a big deal. And it just doesn't seem like it's not reacting right now. But we're kind of also in this period where there's no news coming out from the individual companies of trying to wrap up their year-end reports and stuff. So very little information is coming out on the companies at this point. But anyway, I'm hoping that oil's just in a basing formation. I looked at the IEA report, monthly report came out, and they say that above ground inventories declined again in November and are at the lowest point that they've been in years. At this point, you would think that would be pushing oil prices up, but oil is seasonal. Oil demand is seasonal. And, when you get these big winter storms, people hunker down and they don't drive around. So that cuts down on transportation. But when you get to March and the weather starts improving, from March to June, global demand for oil goes up about 2 million barrels a day. So that should push it back to the 80 range, I hope, at least.
It has been interesting to see those issues in the Middle East just don't have an impact on oil right now. This whole geopolitical or war premium is not in the market for really any sector out there. So then circling back to the supply and demand data here, anything that stood out to you either in terms of North American supply or anything internationally that has swung maybe a little bit more to a balanced market since we have seen a much flatter price?
Yeah, I think what you're going to see next week is EIA is going to report a pretty significant drop in U.S. production for the week ending January 19th. I heard just this morning that North Dakota production is down about 600,000 barrels a day because of well freeze-offs up there in the Bakken shale play. And that's going to be affecting the other rocky stuff in Powder River Basin. And I think this coming week, I expect to hear about a lot of well freeze-offs on the gas wells that are up there in Ohio and Pennsylvania and the Marcellus and Utica. And that happens because with all wells, there's a certain amount of water that's in what's coming out of the ground. And they'll have the gathering lines or something freeze, and then they got to shut in the wells. So that can be a big deal. And then it usually takes quite a bit of time to get those wells back online. You have to have a extended period above freezing before you can get them back online. So we'll see. But then I think people will be surprised by how strong fourth quarter results are. Most of the companies that I follow now, I expect them to beat my earnings per share forecast for the fourth quarter.
All right, well, not much more to say in terms of the oil price. Again, it's stuck in a range. Let's see if it breaks higher or lower. But one thing we all see within the stocks is that a flat commodities price doesn't really excite investors to drive down into the stocks, unfortunately. Let's move over to natural gas because a lot more to talk about here. The last time we chatted was mid-December, pretty much at the low for the natural gas price at about 220 to 230. And then natural gas went up and up and up the whole way through early January, the whole way up to almost 340. But now, boy, oh boy, it had a big drop this week. And now we're trading back in more around the 250 to 260 range. And what's this volatility in natural gas?
Well, natural gas prices in the futures market. The price you see is the front month futures contract. So now they're trading the, gas for February delivery or something. And when the utilities believe they have enough gas in storage to make it through the winter, then they pull out of the futures market. So there's nobody willing to take those long contracts and actually take physical delivery. And then the paper traders that are just hedge funds or something trading the futures contracts, they get stuck in the long positions, then they just have to bail out because they can't take physical delivery. I mean, if they do, they're going to get invoiced for storage fees and stuff. Anyway, it's a very interesting market, and I will tell everybody the biggest price spikes in natural gas futures market, in the futures market, happen not during the winter. They happen during the summer, believe it or not. If you go run like a 25-year chart and just look at the big peaks, and we've seen in the last 20 years, we've had $13 gas. Last year, what do we have? $9 gas or something that spiked to. And what that was utility companies getting into a bidding war with the LNG exporters for physical supply. So they were coming into the futures market. So then you had an excess of buyers for those futures contracts and not enough sellers. So they were bidding against each other. Now, in the spot market down here in Texas, because we had for Texas some extremely cold weather, and we do rely on wind energy. And a lot of times when it's really cold down here, which today it's crystal clear skies, it's going to get below freezing again down in Houston. And so in West Texas and oil fields. And we depend on wind. We have about 13 or 14% of our electricity comes from wind. Well, what happens sometimes is when we're in these high pressure deals is there's no wind and the windmills stop turning. And then they really got to fire up the gas-fired power plants. And so in the spot market down here, I think it's been really active in the last couple of weeks.
What about some of these LNG facility builds? You were sharing with me off mic that some of these are being delayed. So how does that also potentially impact price and also future price?
Yeah, there was two of them that were expected to come online here this summer, and they've been pushed back a few months, and they'll eventually get online. That's going to add about 3 or 4 BCF a day of demand. I've heard that the one problem is, there's a bunch of these things in a process right now, and the construction companies that are building them are having trouble finding quality workers. You don't want to hire a welder right out of welding school to be welding pipes that's going to be taking super high pressures and stuff. So then they got to all be inspected and everything before they can ramp up. But, that's going to impact, maybe if it's not this year, it'll be next year, add a lot of demand. Anyway, we're blessed to have an abundance of gas. It's what keeps our utility bills low, but it's, tough on the gassers. But they can make money. They are cash flow positive, even if gas stays at $2.50. They've suffered through $2.50 gas for many, many years before. If we do ever firmly get above $3, these things are going to be making a lot of money.
Okay, well, I guess we'll wait for it to get above $3 because when it does get above $3, boy, it seems to reverse quite quickly. Let's get into the stocks. I know a lot of our listeners want to follow along with the stocks, and I did have a few emails over the last few weeks asking about dividends and how sustainable these dividends are. I had a listener point to Birchcliff that was paying a 14% dividend, but then announced earlier this week on the 17th that they're cutting their dividend by 50%. Do you think we're going to see more of this from the sector here, Dan?
Well, we have a high yield income portfolio, and I look really hard. These are companies that I followed for a long time, and I only move them in there when I think there are sustainable dividends. The ones that do kind of go up and down with the commodity price directly are the minerals companies. And these are ones that all they do, they own the minerals, and they don't have any drilling costs, and they don't, they just get royalty checks from the operating companies that own the working interest. So they're pretty sustainable, and they would have to have a very long period of time before it would affect their deal, and especially the ones that have a lot of oil production. So look at the production mix. Now, and also I will tell you, one of the gassers is I just looked this morning, NGL prices are going up. With this, cold winter through the middle of the country, a lot of the people that live in the middle third of the United States in the rural areas, they heat their homes and cook with propane. And we've had a surplus of propane, but man, the demand was going sky high. And I looked at the price chart this morning and it's up to 80 cents a gallon. So they're going to be reporting some nice NGL prices. The one I like there is Antero Resources. It does not pay a dividend, but their midstream company, which is publicly traded, is Antero Midstream. It has a really secure fixed dividend, and their future is tied to Antero's aggressive drilling program. So that one looks really good. I like for just safety of dividends, the safest companies would be the midstream companies. I like ONEOK, Antero Midstream there. I like Plains All American. It's an MLP that trades as PAA, but I like the general partner as a C Corp. So you don't have to wait on the K1, and it trades as PAGP. So that's a real solid dividend payer there. So
is it simply just looking at the income statement to gauge if these dividends are sustainable at current energy prices?
Yeah, and then also look at the balance sheet and look at their debt, how it's structured. And the companies that I got in there, they have very little debt problems. I mean, they're super cash flow positive, so they've paid off a lot of their near-term debt, and they don't have any coming due anytime soon. So that would be the big thing. If a company's got, like, in the next 6 months, they got some senior debt that has to be paid off. So those are the ones you kind of want to avoid, because then if you get this period of low commodity prices, it makes it impossible for them to roll that debt over.
Thanks for the insights there, Dan. Please, everyone, keep on sending me your questions for Dan. Let's get into two companies that you have sent me. Both companies are in your Sweet 16 growth portfolio, and you consider both of these companies value plays. So that means that they're both trading at deep discounts to your current valuations. Let's start off with SM Energy, traded SM. It's a mid-cap focused in the Midland Basin as well as South Texas, Eagle Ford area. Now, the current market cap, little over $4 billion. Dan, your valuation here is much higher, almost a double from where current prices are. Take us through what you like about SM.
Well, SM, the SM stands for St. Mary's. When they started, it was in St. Mary's Parish, Louisiana. And today, I don't think they have a single drop of oil production in St. Mary's Parish. So they're based in Denver, and they changed their name to SM Energy. They have two core areas. The big growth area is in the Permian Basin on the Midland Basin side. That's the eastern third of the Permian Basin. It's called the Midland Basin. They're running 4 rigs over there. And then in South Texas, way out west, they're drilling in an area that's kind of gas prone, but it produces a lot of high value NGLs. So that's what I like about it. So they have 2 rigs running there. So they're running 6 rigs total and a couple completion crews. So they're going to have steady new wells coming online all year. They're big enough to where they can fund this, continuous drilling program. And that's important. I like the production mix. It's got first of all, it produces currently about 152,000 BOE per day of production. That's barrel of oil equivalent. It's 42% crude oil, 18% high value NGLs, and about 40% natural gas. But when you look at their revenues are generated by 83% of their revenues come from liquid sales. So look at the natural gas side. If natural gas does ever really bounce up, get well above 3 or something, that would be a big plus for this company. And I actually like that, hanging out their bonus thing. They generated about $500 million of free cash flow in 2023. They pay a small dividend. It's only got about a 2% dividend yield. But now that they've met their debt reduction goals, I think they will be increasing their dividend. In fact, their last dividend was an increase over the prior quarter, so they paid out 18 cents in the quarter. The stock, again, is trading about $35-$36, and my valuation is $58. So it trades, the symbol is SM. Check it out. And they have a very good PowerPoint that describes the business. And so I'd recommend if investors go through that first, and that'll give you a really good idea. But they got a lot of running room. That's another thing I like about this company. Their leverage on the balance sheet is really low now, and they have a lot of running room, a lot of high-quality drilling locations, which also makes it a takeover target for a larger company.
So, Dan, regarding growth here of SM Energy, it's about a 4.5% year-over-year production growth, which maybe doesn't excite some investors. And as you said, current dividends only around 2% annual yield. So this doesn't really seem so much like a growth story, more of just a story that's being very much unloved by the market.
Mm-hmm. Yeah, and they were a much more aggressive growth company a few years ago, and they got the message from the market. They said, we want to see dividends. We want to see you guys pay down some debt and everything. And their management team took that advice, and they've really improved the balance sheet. I mean, if you go back like 3 years ago, like the end of 2019, before the pandemic, it was a pretty leveraged up balance sheet. Well, it's in really good shape now, as they've paid off a couple $2 billion worth of debt in the last few years.
Okay, so now it's more about returning capital to shareholders.
Yeah, return to capital. Yeah.
Hey, I've heard from a lot of companies, energy companies, that is what investors are looking for. Let's move on to the other company that you wanted to share here, Vital Energy, traded VTLE. This is a smaller company, especially compared to SM Energy. This is about $1.5 billion market cap. You have a much higher valuation here, over double the current $42 share price. Why do you think this one's being so unloved?
Okay, one reason I wanted to mention this today, it's not quite as big as SM. It's got on a production. It just reported fourth quarter production of 113,400 BOE per day, but it's got a more oily mix, which makes those BOEs more valuable. So it's 70 or 47% crude oil, 25% NGLs, and only 28% natural gas. So I think when you compare this directly to see where SM's trading at, a market cap of 4 billion, and this one's only trading at a market cap of 1.4 billion, I think. Look, if you compare it directly with SM, it's a double. It should be a double just to get to where SM is trading. They completed last year two very transformational acquisitions. One of the negatives about this company, it didn't have a lot of real high quality running room. A lot of their Permian Basin assets are in the Midland Basin, an area that a lot of people consider kind of tier 2 acreage, but they made some big acquisitions last year, which have increased their production from the first quarter of 2023 to the fourth quarter. Their production's up 41%, primarily because of those two deals, but it also gives them a lot of high quality running room. And if this is a pure Permian Basin company, and the acquisitions gave them a really nice foothold in the Delaware Basin, which is the western part of the Permian, where some of the best wells in the world, literally the best wells in the world, are being drilled in the Delaware Basin. They're coming on at 4,000 or 5,000 barrels per day. And they released an operations update on January 9th that just crushed my fourth quarter forecast. They beat way above the high end of their guidance for the quarter, beat my forecast by 8,000 BOE per day, a pretty nice beat. They are free cash flow positive. They're generating about $50 million a quarter of free cash flow, and I think that they'll be able to maintain that even if oil stays at around 70. The balance sheet is not quite as strong as SM's because they've made these two big acquisitions with like half debt and half stock. If you're familiar with Earthstone Energy that I've mentioned on your show several times, that's been acquired by Permian Resources, Vital is doing everything they can to become an attractive takeover target. I mean, they're going down this path just exactly where Earthstone went. And there's probably going to be a lot of people looking at this company if they're looking for a takeover target. And this would be a couple $1 billion deal to buy it if it happened.
Okay, so those acquisitions, the two of them from last year, already filtered into the production for the tail end of last year. How much more could they help increase 2024 production?
Yeah, I got them going up. Hang on, let me get. Oh, and one thing I want to point out too is they've hedged about 93% of this year's oil production is hedged at $75, and they did that to meet their debt covenants and to lock in that free cash flow. So that's a good thing.
So then in terms of the acquisitions, then we were going to get to the hedging, but look, they've already locked in $75 per barrel. What about the acquisitions? How are those going to continue to grow the company this year?
Well, I mean, they have not given any guidance yet for this year, but my forecast and my valuation is based on only 115,000 BOE per day, which now that this, big production beat for the fourth quarter is out there, I'm going to probably need to increase my production forecast by about 10,000 barrels a day. So, they'll give more guidance when they release their fourth quarter results, but which are going to be good. I'm telling you, at that price, they're going to report about $2.85 earnings per share. Now, remember, this is a stock trading for like $40 or $42, and they're going to have full year reported earnings per share of over $20 a share for 2023. So this stock's trading for like a PE ratio of 2. The operating cash flow for 2023, $37 a share. So it's trading just barely over 1 times cash flow. When I was working on M&A stuff for Hess, this company would be a screaming takeover target for us. Now, big companies like Hess or, Exxon, why did Exxon buy Pioneer? They buy these companies not as much for their current production. What they're buying them for is their acreage. their leasehold, how much drilling inventory they have, because a lot of these big companies are constantly wanting to maintain their drilling inventory, high quality drilling inventory. And that's what I think makes this one really attractive. And some of these wells they reported coming online in the fourth quarter look really, really strong. So it didn't get the attention. I mean, right now, like we discussed before, it's kind of like the whole sector's just, under a dark cloud or something. I don't know what, but man, when I saw that operations report, I was like, wow. And I think the stock just barely moved that day.
Yeah, it seems like investors just distracted by other sectors. Look at how strong the equity markets, tech stocks ended this week too. So it is one of those, as we said early on here, is that if the underlying commodity price is not moving higher and seems like moving higher every day, well, some of the underlying stocks, most of the underlying stocks, more or less just get forgotten. But hey, Dan, thank you so much for your insights. I love reading over your work at the Energy Prospectus Group. We'll be chatting next month. So everyone, keep sending me your questions for Dan. Keep sending me your questions for all the guests we have on the show and the companies that we feature throughout the week on our website, kereport.com, and podcast The KE Report. I thank you all for tuning in this weekend. I hope you all have a great rest of your weekend. We'll be back next week at a conference in Vancouver, but throughout the later part of the week, check back on our website. We'll have plenty of updates to give you. Dan, everyone, have a great rest of your weekend.
For our upcoming appearance schedule, visit kereport.com. The Corlin Economics Report will be back in just a moment.